Hi all, I am Sham and I have
Hi.
Kish with me. Welcome to this week's Free Float. And the topic uh, for today is volatility. Um, we all know that markets go up and down, but the question is why? And the second thing is, there's a lot of, discussion and a lot of flaming going on about value investing, quality investing, momentum investing, and so on. And each proponent, the proponents of each investing strategy claim that theirs is the best. And they all say that the other person is only looking at price and and not looking at quality, or not looking at whether you're buying it at the right price, so on and so forth. So there's a lot of discussion about it. But hopefully the post kind of says
Yeah.
why all of them are right and wrong at the same time, right? So Kishan, can you walk our viewers through the essence of the post?
Yeah. So I think the post is, first of all, very well written in the sense that it attacks the problem like head on. The essence of the post is that, volatility is the price you pay to be in the markets. You know, people get very, when the markets are volatile, people get, extremely tense. Like you mentioned, the March of 2020, where sentiment, was extremely week when the world. It seemed like the world was going to end, and the markets were, you know, pressing in that kind of event, and so and you saw. I think I've never seen this before. I mean, I've never even read this before. Where day after day you had markets going, in up freeze, down freeze. Sometimes multiple times, and both. You saw up and down freeze. Back to back. All over the world. I don't think anyone has seen that before. And what took to stabilize the situation was, central banks, the Fed, the market participants, came in and, provided ample liquidity, which stabilized the situation, and normally that happens because, in a very world-like situation, the market trying to press in very, very different kind of scenarios. And normally, when you have such violent moves up and down, it normally is suggestive of a very uncertain situation. You see this happening during the budget a lot. In the Indian budget, when the finance minister is speaking, you see the market going up 2%, then down 2%, and then after she starts speaking, the market then goes up and down, and then finally it makes one move up. And that's that happens when the market is trying to press in a certain information, and you see a lot of noise around this in social media and in social and then people start talking, like it comes on front page news on the TV, like general TV and stuff. So it's like, oh my god, the market's fallen 3%, while everyone ignores that the water market did for the last 1 year. It's up 100% from the lows, but oh my god, it's down 3%. The market's crashed. And so that all kind of builds into the general sentiment. While I think most professional investors, do not look at the market as a. They don't want. I think for most professional investors, it's not returns that this. It's not high returns they seek. It's more like more consistent, return on the capital, which is very different from from what the general public or the general sentiment on Twitter, what they think of the markets, or how they approach markets. Completely different from how a true professional investor would approach investing money.
Right.
Where we're trying to limit volatility, having a more consistent strategy, and having a not trying to. I think you see this on Twitter a lot. 30%, year-on-year return. That's the aim of some people, and for you to aim 30% return, you'll have a lot of. Especially if you don't have like some Renaissance type of a strategy, which is like where you have some mat wizards and veteran scientists trying to figure out how to beat the markets. If you're just doing plain vanilla investing, you'll have a lot of volatility in your strategy.
Right. So I think a lot of people are confused between what drives price, right? So they all claim to do a lot of fundamental analysis, looking at balance sheets, and figuring out what is the CEO's favorite restaurant, and all that scuttlebutt nonsense. But ultimately, it doesn't matter, in my opinion. Not that fundamental analysis doesn't matter. It does matter, but what doesn't matter is you doing it. So the whole idea behind the price is that there's only one price in the market for a security at any given point in time, and that price encapsulates the sentiment of a wide variety of buyers and sellers. Some people may be selling it, like you mentioned, Renaissance, right? The holding periods is in seconds, or maximum it's like a couple of minutes. And they're also buying and selling the same security at the same price as compared to, say, Warren Buffett, whose average holding period is like decades, right? And they're all in the market at the same time, transacting at the same price. So what is one man's trash is another man's treasure, and vice versa. So you may have a 10-year view, or a 2-year view, or a 1-minute view. Irrespective of what your time horizon is, when it comes to equities that are traded in the market, the whole voting machine versus weighing machine difference is moot. The only thing that matters is the voting machine at that point in time.
Yes.
And it may never converge. So there are multiple instances of so-called value investors who have kept on saying that the market is in some sort of an orbit, and Fed driven liquidity, blah blah blah, and they have been bearish for decades. Not decades as in plural, but they've been bearish since like 2008 or whatever, right? A prime example is that Huffman character. So he's been saying this whole thing is going to collapse, and the price keeps rocketing up, and ultimately, for an investor in his fund, his primary responsibility is to generate returns for his investors, and he has failed in that responsibility. Instead of that, he's gone off into a tangent. So my point is that in an open-ended fund, that is investing in securities that are perpetual, which is equities, there's no such thing as a terminal date where the weighing machine comes into play and you get paid the fundamentally right price for that security. Equities are perpetual, right? So they can exist for 1,000 years. They're not like bonds that have a fixed maturity date. So with the bond, you can say that I'll ignore the short-term fluctuations in price, because I know that at maturity, thanks to my strong fundamental analysis of the company's balance sheet, I'm going to get paid par. I can make that claim with bonds, but I cannot make that claim with equities. With equities, the prices can be, first of all, nobody knows what is the fundamentally right price of any stock. Spare me that BS. Nobody knows what the right price is for any stock. Whether it is going to trade at 10 times earnings, or whether somebody is willing to pay 20 times earnings, is just a function of market sentiment. If the market as a whole reprices the security, it's because the sentiment around it changed. That's it.
Yes.
And historically, the multiple on earnings has been more important than earnings itself. For like decades, markets have gone into a loop where the companies themselves have not grown earnings in the aggregate. So you can look at the S&P 500 and you can look at the Nifty also over the last 10 years or whatever. Earnings itself have not grown.
Yeah, I mean, which is very true for India in the last 6-7 years, where like if you take a stock like Asian Paints, I think earnings growth, the last time I checked, maybe it's in the last year it's improved, but it was like probably 6% or something, while the stock PE has expanded from like mid-20s to now probably 60, which has driven all the increase in its price.
Yeah, last time I checked on NSE, it was like 100 PE or something. So my point is that multiple is determined.
But that's true volatility. I mean, but that's true. I mean, that's a different kind of volatility. I think that kind of volatility is what you think about high growth companies, which are very high PE because it's growing very quickly, and if suddenly if their earnings have a beat, have a miss, if the earnings have a miss, then the stock corrects because the earnings get the expectations get adjusted. I think that's a very different type of volatility compared to market volatility, which is driven more by your if you go from a very technical way, it's driven by risk premium. Risk premium being increasing or decreasing based on news flow, or based on
but see, it's simple, right? What is risk premium? Essentially, it is what somebody is willing to pay over and above a risk-free rate, right? So what drives that? It's finally that investor sentiment, right? The investor is feeling bullish. He's willing to pay more for the same cash flow. If he's feeling bearish, he is like, okay, I want to I want to pay a lot less for the same cash flow. So what is important to understand is the cash flow of the company, even if it is the same, even if it doesn't change, even if earnings if the company comes out and says, I'm not going to grow my company at all, I'm just going to be stable at this earnings, even then you're going to see ups and downs in its price because of sentiment. And and the problem is that when you invest, you have a bounded time horizon. You're investing for 5 years, you're investing for 10 years, you're investing for 20 years, but the market's time horizon is infinity, right? The market exists way longer than your time horizon. And these equity securities are perpetual. So, so they also exist way longer than, your time horizon is. So you're just looking at that particular section for yourself. And when you do that, you're completely at the mercy of sentiment.
Right. And, I think a point here that has been made is that, most equity investing is you must invest with at least like a 5-year view, right? I mean, if you have like a 2 to 3 year view where you want to park some money for some or you think you need, and you cannot afford to lose say 50% of the money, because you cannot say what will happen in the next 6 months or even 3 years, right? So you can actually end up losing a substantial chunk of the money in that period. And if you invest 100%, you're risking that money. So you should not be doing that in the first place. So all equity investing, even if you you invest like a very small portion of your total wealth, and you have no no hedging, you're not limiting the volatility by diversifying or so into debt or stuff. You should be prepared for like a model. Like you tell me this all the time that strategies will lose at some point that more money. So
so that's exactly my point. So when you say 5 years, right, so that's a very bounded time horizon. Now if I invest at day 0, right, and
then
I see my stock, or my portfolio go up and up and up, because market sentiment is generally favorable. But at the time I go to redeem, right?
the market might fall.
Yeah, it might fall like
Yeah,
50%. So my point is, both at the point of entry and at the point of exit, you're completely at the mercy of sentiment. So in between, a lot of things can happen. And the reason why advisors and we tell people to have like this long term goal is that in the aggregate, right? If you want average returns, those average returns can be had only if you have a time period that is long enough to even out both the pluses and minuses of this sentiment, of this volatility, right?
I agree.
And it gives you the ability to sort of chart out a glide path. So initially you may be exposed to you can expose your portfolio to a lot of volatility, but as I mentioned, bonds are not going to be that volatile because they have like fixed maturities where that weighing machine comes into the picture. And
you've seen bonds like fixed maturity plans extending the maturity date, and I mean, some crazy things have happened.
Yeah, so extreme stuff always happens in the markets, right? So by definition, the minute anything starts trading, I think we spoke about this problem with financialization, at the beginning of our free float episodes, right? So you have an asset which is fairly stable, but you take that and you financialize it and put it in a market, right? You'll suddenly see its price, go up and down, up and down, up and down. So that's the nature of the market itself, because the market is, the price ends up being a measure of sentiment, and sentiments keep changing over time for the same asset. And we've seen this happen, in gold primarily. So for the longest time, the only way you could buy gold was to buy bullion, which is, actual physical gold, or you need to have a futures trading account to go and buy gold in the commodity exchange, right? But then in 2006 or 2007, gold ETFs came into the market. So you could buy a gold ETF with just a trading account, with just an equities trading account. And a few years after that, gold became just as volatile as somewhere between stocks and bonds. So its volatility profile started matching that of every other financialized asset. So so the easier you make something trade and you put it in the market, sentiments starts driving the price of it, and volatility starts affecting it in a way that it affects every other thing that is traded in the market.
Right. I think this is like this is also based on your risk profile, right? So when you do the risk profile questionnaire, you ask people how much volatility will they be comfortable. You ask question like if the market falls 20%, how would you react? Would you invest, or and the risk taking ability that or the willingness that they have. Now what do you say is that someone is very risk averse? I mean, because normal thing for the average investor that you invest say 20% in equities and then 7% in debt. Is that the only way?
Yeah, that's probably the only way, Kishan. So the biggest problem that I see is, it goes back to the voting machine versus weighing machine, quote from Graham. You need to, like, there are some assets where, the convergence to that weighing machine happens fairly quickly, right? So even if there's a dislocation, right, it quickly comes back to its fair value. But there are some assets where first of all, nobody knows what the fair value is, typically in equities. And when there is a divergence, it may never come back to its old steady state, right? And commodities are a prime example. So, nobody really knows, where how supply is going to behave, where demand is going to go. So it's always in a sort of flux. So you will see. So it can very well be range bound, but you will see a lot of ups and downs within that range when it comes to commodities. So the only way you can sort of make sure that this weighing machine works in your favor is by diversifying and keeping it simple, just equities and bonds, because equities is where most of your returns are going to come from. Bonds are there to sort of act as like an anchor, and just have this just take this idea away from your mind that just because, even if you sort of did this right, even if you had a 60-40 mix or whatever, right, your portfolio is still going to be volatile, because ultimately all those instruments are linked to the market. So anything that is linked to the market is by nature going to be volatile. There's no escaping it. Like volatility is one of the biggest, sort of nature of the market. Like you can't remove volatility from markets.
Right? Very true.
So it's better that investors kind of embrace the notion that the minute they enter the markets, things are going to be volatile. Number one. Number two is they're always at the mercy of this, this volatility, irrespective of what the time horizon is. They're always going to be at the mercy of this. There are some ways in which you can, sort of tilt the odds in your favor. So with a long enough time horizon and a glide path, you can, sort of get your average returns out of equities. But everything else is driven by sentiment and volatility. You have to kind of internalize this lesson, that we've seen over the last couple of decades, right? So most of most new investors kind of pat themselves on the back because they've been lucky that they enter the market when sentiment was at rock bottom, and it drastically improved. So for the same earnings and the same cash flow of underlying cash flow, the market paid higher and higher multiples. That doesn't mean that the reverse cannot happen, right?
Right. And the other thing that you always mention, that we mentioned, is that there's a difference between volatility and like permanent drawdowns, right? So like most people say that they are okay with short-term volatility, like it happened like March 2020, where the markets just didn't come back, but they came back with some, with ferocity. But there can be situations where the risk are not just where the markets are you could say overreacting, but but which could be like real. And this things you see normally when someone has a very concentrated portfolio of stocks, and maybe we think of 15%, 15 stocks as very large. But say someone invested in, I don't know, Z, or say ADAG group of stocks, and there would be also a lot of stuff, like back into the hoping for all these stocks to come back at some point, and what you will have just permanent inversion of capital. That's very different from market beta volatility.
Right, absolutely. So investing in individual stocks it's a bigger minefield than buying a portfolio and following a strategy, and that's exactly what free float is about, right? Don't pick stocks. So
because you see a lot of people just buy, say probably like 5 stocks that they like, and normally these are not even like some people buy like large IT like IT and bank stocks and stuff and Reliance stuff, but a lot of people just play around in mid caps, small caps based on hype, and hoping that they'll just hold on when the stock falls, and that stock never recovers. So it's a very, it's a very different kind of volatility.
Yeah, that's true risk. because I think people get confused between volatility and risk, and volatility is just driven by sentiment, whereas risk is, the true risk of the business going bust, or some operator pumping stocks and getting tail people jumping in with no exit. So so that's risk, and that's a separate topic. And
we
and
should
the
we
two
should cover
should not
that,
be confused. Yeah.
No, but we should cover that, like, don't confuse volatility with, like, with, I don't know, stupidity, or like, or like, like very risky behavior. Like, don't confuse, like, investing, because I know someone who recently bought a large chunk of ADAG group companies, like recently, when it's trading at like 5 rupees a stock, hoping for I don't know what, and I mean, I just couldn't say anything, because people do all kinds of things, and and if the stock falls, there's no, you cannot. I mean, you're basically writing off that capital,
Yeah.
But people like doing.
People like buying lottery ticket type stocks, because I remember when Kingfisher was about to just before Kingfisher was about to file for bankruptcy, there were a lot of people buying that stock at 5 rupees, thinking that Malia will figure out a way to to resurrect or whatever, right? So as long as you're aware that it's a lottery ticket, that's fine. But
if you base your investment strategy on these lottery tickets, that's because I mean, that's important, that that kind of volatility that you will see in stock like that is far more dangerous.
Yeah. So that's definitely risk versus volatility debate. But hopefully, the takeaway from this article should be that first of all, you're always at the mercy of market sentiment, because you have a bounded time horizon. You don't have an infinite time horizon. So don't expect markets to be stable. There's no such thing as a steady state in markets. They're always going to be volatile. In fact, if the stability is actually the anomaly, volatility is the norm. So expect markets to be volatile always. So don't expect it to be calm. And number 3 is, for weighing machines work, when there is when you're dealing with bonds which have a definite maturity date, or bond-like instruments, whereas stocks are mostly at the mercy of the voting machine. So sentiment matters more than anything else. And obviously there's a difference between volatility and risk that we spoke about in the end, and we'll discuss risk versus volatility in subsequent posts. But I hope people are not in 100% equity portfolios at this point, and they have a bit of bonds into the mix to kind of give some stability. And as we enter a more and more volatile phase, because this corona also keeps going, is back on a second wave. So hopefully your portfolios are robust enough to handle it, and be what it is. Don't panic, stay invested, and good luck. So we catch you again next week.